Well, hi there. It's Thursday, the 22nd of November, and I thought I'd record this in addition to my recent business update, just a little update on markets. Well, it's been quite an interesting 6 weeks. Now, typically around September and October, you do tend to see a lot of volatility in markets. It's a seasonal thing. But we saw something in February where markets took a big correction, and we've certainly had a big correction in markets here in Australia and overseas during October. Australia, we were down over 6%, and the overseas bourses were down even more. So what's going on? Well, I'm going to talk to you about three things just quickly. It's going to be the trade wars, interest rates, and what's going on here in Australian property. So trade wars. Well, I think this is probably one of the big things that markets are worried about. It's Donald Trump's trade war against China. Now, he's been preparing for this for quite some time. He's juiced the American economy up from going strong to super strong with these tax cuts. He's gone a couple of rounds with allies in Europe and Canada, fought a little bit of a trade war with those countries just to warm up for the main game, which is China. And he's right in the middle of this trade war in China, and it's a standoff. And things tend to change every day from Donald Trump's tweets. Now, what's recently at play, we've seen oil prices plummet. And again, Trump's in the market there trying to manipulate the price of oil down. Well, at least that's going to make petrol cheap at the bowser for us, but it's not great for the world. If we see a protracted trade war between the US and China, no one is going to win. I think generally a deal will be done. It's just a question of how long and how they're going to come up with a deal where both leaders save face, and that's going to be ultimately important. But that's a big concern for markets, and if that was resolved overnight, we would see a significant bounce in equity markets. Now, the other concern at the moment is interest rates and how fast or how quickly or how high will those rates go. Now, the US has been on a rate tightening cycle for some time now off the back of a really strong economy. So that's not a bad thing, and things have been telegraphed very clearly from the Federal Reserve. But it takes time for these interest rates to feed through in the economy. And with the trade war going on and the rate rises starting to bite, the Federal Reserve may start to taper off their rate rises. Nevertheless, we're definitely in a period where we've gone from ultra low rates to rising rates, and we're in an environment with more debt. And rising rates and high debt really put a risk to asset prices. And that's another thing that's going to be a cause of constant concern for markets here on in as this bull market really matures. So Trump, trade wars and interest rates really have a big impact on equity markets at the moment. Now, closer to home, the headlines seem to be around property, and we've seen a slowdown in Sydney and Melbourne. Well, look, if you take a step back and see how much prices have risen over the last 5 years, a 10% decline is really not significant, is probably welcome. But the real concern here is how far will it go? And there's a couple of things to think about in terms of property prices and a potential crash and what might cause that. The three things really are interest rates, cost of money, unemployment, so people having a job. If they don't have a job, they can't pay a mortgage. But the third thing, and the thing that's starting to cause a lot more concern, is the availability of credit. Now, we've seen lots of policies come in over the last couple of years to engineer a slowdown in the property market by restricting credit, by restricting investor loans, by making the criteria for loans tighter. Or add the Royal Commission to this scenario, and there is a real risk that credit gets even tighter. And if there's no money being borrowed to go into the property market, then that could really trigger quite a slowdown. It would certainly be exacerbated if unemployment hit or interest rates got too high. We're certainly not seeing those two factors at play at the moment. And really the general consensus is that the property market will gradually come back and potentially might see a 20% fall in Sydney and Melbourne. But we certainly have to watch this space. More broadly, the Australian economy seems to be doing pretty well. We are a very diverse economy. We're starting to see some more activity in the mining sector and out west, and we've certainly still got pretty strong activity here in New South Wales. But certainly property is catching the headlines for completely the opposite reasons to what it was a couple of years ago. Anyway, look, there's a short update from me. I hope you're well. At the bottom of this email, there is a link to book a meeting. We will certainly be talking to you before Christmas. For those people who are running direct portfolios, there is certainly some investments in the pipeline that I'll be having a chat to you about as well. But if you want to catch up or have a chat, please feel free to book a meeting in my diary at the bottom of this email, or just give me a call. Bye for now.